All right, here we're going to be looking at a consolidation for an intra-period purchase using the cost method. And the example here is where the parent purchases the subsidiary on July 1st of the year X1. So what we have to do is we have to account for the period at the beginning of the year. That would be from January 1st through the July 1st purchase date, and then also account for any changes after the July 1st day through the 12/31 or end of the year date here when we make our consolidation. And what I'm going to be looking at here is just contrast this cost method here with the equity method. So if you understand the equity method, you can see what differences are required here using the cost method. Okay, going over the key points that would have to be made here for this interim purchase here, or using the cost method. Now the first thing we have to look at is our retained earnings here for the and that would have to be based on the purchase date of 7/1/X1. So we have to update these retained earnings for the subsidiary based on the purchase date, and that would be the same method as we use for the equity method. So what we do is we close all the nominal accounts here for the subsidiary to the income statement and then subtract out any dividends declared, if any. So the retained earnings would include any income or loss for the first 6 months of the year less any dividends declared. So going up to our diagram here, for our net income, we close our revenues, our expenses, and our cost of goods sold here to the retained earnings account here, and then we'd also reduce the retained earnings here for any dividends that were declared. So this is where we'd have updated our retained earnings here for the subsidiary as of the purchase date here, 7/1/X1. Okay, next we have to update the parent's investment account here in the subsidiary. And for our example here, we're going to update that to the January 1st of the second year for the consolidation. So using the equity method, we came up with an investment here in the subsidiary of $236,800 here. But using the cost method, we have to derive that in a different fashion here. And what we do is we use an equity conversion here, where we take the retained earnings of the subsidiary. In this case, it's going to be at the updated date here of January 1st of the second year, which we calculated to be $150,000. And then we take the retained earnings of the date of purchase. That's the updated retained earnings that we made here for July 1st of the first year of year X1 here, and that was determined to be $116,000. So what we do is we just take the change here between the beginning of the year here of X2 and the retained earnings here for January 1st of the X1 year here, or July 1st of the X1 here. So the change in the subs retained earnings was $34,000 here, and the parent's ownership would be 80% of that. So the equity conversion here for the parents would be $27,200. Now remember here, when we use this equity conversion for the years after, like years 3, 4, 5, and 6, it's always going to be based here on this retained earnings on the purchase date here of 7/1/X1, even though we will be using different retained earnings dates here, but it comes off this retained earnings here of 7/1/X1, the date of purchase here. So going down to our worksheet here, looking at the investment account here, what we would do is we take the purchase price, in this case it was $212,800, plus the equity conversion here that we had for $27,200. You add those together, and then that gives us our investment here account in the subsidiary for $240,000. Okay, just so we understand here, when we're making this equity conversion, that's based on the last 6 months of the year here for our example, and that was based on the change of retained earnings since the purchase date here. So we had the 7/1 or July 1st of year X1 purchase date, and then we'd be comparing it to the retained earnings at the end of the year essentially here, for that would be the 12/31/X1 date, which is actually, that would be the same here as the retained earnings at the January 1st date of year X2. And that is what we use here for calculating our investment here in the subsidiary. And the purchase price here is based on the July 1st purchase date here for the subsidiary. All right, our last key point here has to do with what income we recognize from the subsidiary. Now, using the cost method, you only recognize the dividends received here from the subsidiary, and you don't recognize any percent of the parent share of the income actually earned from the subsidiary. So looking at it and summarizing it here, the consolidated income here of the parent includes only the share of the subsidiary dividends declared, and this is after the acquisition date, and those would be only the dividends actually received here from the subsidiary. But the sub's income earned and the dividends paid prior to this acquisition date would be included here in the retained earnings up here that we recalculated here based on the purchase date, and that was the same using the cost method here and the equity method. But the income that we recognize here using the cost method would be only for the dividends received here from the subsidiary, and that's as of the purchase date, between the purchase date here and the end of the year. But we don't recognize any percent here of the subsidiary's income that would be allocated to the parent as it would be here for the equity method. We don't recognize that. Okay, next looking at our eliminations and adjustments here using the cost method. Now, all I want to point out here is that when we use the equity method here, we recognize the parent's portion of the income that was received here from the subsidiary. In that case, it was 80%. Now, with the cost method, we would have not had this recognized here, so that wouldn't exist. So the only income that we'd have to eliminate would be the dividends received here from the subsidiary, and we would, in that case, we would have debited our investment account here in the corporation for $8,000 here, and then we would have credited the dividends declared here for $8,000. So we would not have recognized any of this, wouldn't have to eliminate any of this subsidiary income here using the cost method. And then other than that, we'd go down and we'd be looking here at our distribution schedule, and that would be the same for the cost method versus the equity method here. So this distribution schedule, that must be based on the shareholders' equity at the interim purchase date here. And for our example here, it was 7/1x1. And then again, to point out here, the retained earnings here on our distribution schedule, that would be based on the updated retained earnings here on 7/1x1 in this purchase date. And then for our example here, our excess of the fair value or the book value, we calculated that here based totally on the goodwill here that was allocated for the parent here in a non-controlling interest and the total goodwill here. So going back here to our distribution schedule, we would eliminate 80% here of the book value here of the equity of the subsidiary, and that would be the same here. We would eliminate that here, debit to our equity account here for the subsidiary's common stock and the retained earnings, and then we would credit or reduce our investment account here for the balancing amount. So what we're doing here is the same adjustments that we'd be making during the using the equity method here off the distribution schedule. And then our excesses here would be to the goodwill, debit goodwill, and then credit the investment account here for 40% of that goodwill, or reduce it for 80% or $40,000 in this case, and then the remaining amount here would go to retained earnings of the subsidiary for $10,000. Just to make a point here though, we wouldn't have to take care of or eliminate 80% here of the sub's income using the cost method, because we would have never recognized it in the first place.